In a world of rapidly rising inflation rates followed by rising interest rates, our life savings are significantly devalued and goods and services everywhere are getting costlier by the day. One of the ways we fight inflation is to ensure that our wealth yields a certain amount of cash that often offsets the effects of inflation. If you're actively scouring the stock market for bargains, dividend stocks are one of the ways we beat inflation, and we're here to help you find the best ones out there. We do tons of research about the stock market, and our goal is to help you on your journey to financial freedom so you can live life on your own terms. That being said, we're here to bring you the 5 best dividend stocks to buy right now. If you like this video, make sure to destroy the like and subscribe buttons so you won't miss any of our future content. Make sure to stay till the end, as our last stock pick is our favorite and we think you'll like it too. Now let's get right into the video. First off, we have Best Buy BBY. Retailer of consumer electronics, Best Buy has locations in the United States, Mexico, and Canada. The company sells a wide range of goods at its physical stores and online, including mobile phones, digital cameras, video games, music, and household appliances like refrigerators and washing machines. Through its Geek Squad brand, Best Buy also offers repair services for computers and other gadgets at its physical locations. As Americans upgraded their home offices for a new routine of remote work, the shop was one of the few to prosper during the epidemic, posting a 144% gain in U.S. online sales and an 8.3% jump in overall sales in 2020. Prior to the COVID crash in March 2020, Best Buy's stock price has risen from $48 to $92 from December 2018 to December 2019, yet plummeted to $50 in March 2020. Since then, the stock has recovered from these lows and even surpassed its previous pre-pandemic peak. Its price has consolidated between $100 and $127 till the end of 2021, yet due to the current macro climate, the stock lost most of its post-COVID crash gains and settled at a range of $62 to $68 at today's prices. The operational environment at Best Buy is becoming more difficult. The business anticipated reduced sales for the year due to challenging comparisons driven by pandemic-related demand for technology goods and services, which was supported in part by stimulus funds. It was also correctly predicted that consumer spending would significantly move toward experiences like travel and entertainment. Best Buy did not account for unprecedented inflation and its ensuing effect on demand. Trading down is common among customers from lower-income households, especially in the television category, and Best Buy is noticing an increase in interest in sales occasions more generally. These may all sound negative, but if we closely look at their numbers, they definitely tell a different story. Best Buy's revenue has steadily grown from $44 billion in 2012 to $51.7 billion in 2021 and averaged $43 billion in the past 10 years. Its operating margin has grown from 5.5% to 7.7% in just 10 years, with an average of 6.2% annually. Furthermore, its return on invested capital has significantly grown from 21.6% in 2012 to 59.2% in 2021. That's an average of 28.2% per year. Our model suggests that in the next 5 years, Best Buy is poised to deliver at least 17.4% annual returns, with an average dividend yield of 4.2%. Next up, we have a company called Coterra Energy, Inc. Coterra Energy Inc. is an independent oil and gas company that engages in the development, exploration, and production of oil, natural gas, and natural gas liquids in the United States. It primarily focuses on the Marcellus Shale, which occupies around 177,000 net acres in Susquehanna County, Pennsylvania, in the play's dry gas window. The company also owns holdings in Oklahoma's Anadarko Basin, which has about 182,000 net acres, and the Permian Basin, which has about 306,000 net acres. Moreover, it runs collection systems for natural gas and saltwater disposal in Texas. Coterra offers its natural gas for sale to industrial clients, neighborhood distribution firms, oil and gas marketers, significant energy firms, pipeline firms, and power-producing facilities. Looking at the price chart of Coterra, its stock was trading around $20 a share in March 2020 and dropped 35% within the same month due to the intense fear of the global lockdowns. In spite of this drop, Coterra still outperformed its peers when the energy sector dropped 62% within the same period. Coterra recovered gradually from the lows of March 2020 and has risen roughly 110% to today's prices. On the strength of a surge in energy prices, Coterra Energy became one of the most recent oil and gas companies to report huge quarterly profits and increase shareholder returns. Energy prices have reached multi-year highs this year as a result of Western sanctions against major supplier Russia and OPEC Plus's decision to reduce supply in an already constrained market. Coterra promised to increase cash dividends by 5% over the previous quarter and to return approximately a third of its free cash flow to shareholders. Coterra's quarterly earnings increased from $64 million last year to $1.2 billion as a result. Judging Coterra by its numbers, it has booked average revenue of $2 billion over the past 10 years, from $1 billion in 2012 to $3 billion in 2021. That's a 200% revenue growth in just a decade. What's interesting, though, is its operating margin. Historically, profitable companies have an average of 10 to 12% operating margin across any industry. Coterra outperforms this benchmark by having a 25.4% average operating margin for the past 10 years. That's from 21.2% in 2012 to 48.5% in 2021. Its return on capital invested has increased from 4.2% to 12.7%, averaging 5.9% per annum over the same period. Based on this data, our model predicts that Coterra will have conservative annual returns of 11.5% over the next 5 years. Coming up next is a company most of us love, the Coca-Cola Company. The Coca-Cola Company is a global American beverage company that was established in 1892 and is best known for being the maker of Coca-Cola. The Coca-Cola Company also produces, sells, and markets alcoholic beverages as well as other non-alcoholic beverage concentrates and syrups. Coca-Cola is the largest beverage manufacturer and distributor in the world and one of the largest firms in the United States, with more than 2,800 products available in more than 200 countries. The drink Coca-Cola was originated in 1886 by an Atlanta pharmacist, John S. Pemberton, at his Pemberton Chemical Company. Frank Robinson, his bookkeeper, came up with the drink's name and gave it the flowing writing that would later become synonymous with Coca-Cola. Based on cocaine from the coca leaf and caffeine-rich extracts from the cola nut, Pemberton initially promoted his beverage as a cure for the majority of common ills. Shortly thereafter, the cocaine was removed from the Coca-Cola formula around 1903. Pemberton supplied local soda fountains with his syrup, and with the help of advertising, the beverage saw incredible popularity. The Coca-Cola trademark was registered in the U.S. Patent Office in 1893. Before the pandemic hit, Coca-Cola's stock was trading at around $60 a share. This crashed to $36 a share in March 2020, a 40% drawdown from its previous peak, as investors feared a global recession brought by the health crisis. Since then, the stock has gradually risen and is now trading above pre-pandemic highs in spite of the current bear market. Warren Buffett, arguably the best investor of all time, has Coca-Cola on his list of all-time favorites and longest-held positions. In 1988, Berkshire Hathaway began acquiring shares of Coca-Cola Co., and it has since continued to do so. Currently, Berkshire Hathaway holds 400 million shares of Coca-Cola stock, or nearly 8% of the firm, with a staggering market value of $22 billion. Berkshire Hathaway is sitting on enormous gains in the company because the stock was only a few dollars a share when Buffett started buying the business in 1988. In addition, Coke pays out a quarterly dividend of 44 cents, bringing in a total of around $1 billion annually. The same reason Buffett favors every firm he invests in is why he likes Coca-Cola stock, and that is called value. This is meant in two ways. First off, he has a reputation for only investing when the price is right and not a penny more. At the time, Coca-Cola stock had a favorable pricing and an intriguing competitive advantage. Coca-Cola owns nearly 50% of the US soft drink market, so as long as people are drinking soft drinks, Coke will be performing well. Looking into Coca-Cola's numbers, its revenue has averaged $40 billion over the past 10 years. Although this has dropped from $48 billion in 2012 to $39 billion in 2021, its operating margin has steadily increased from 22.4% to 28.6% over the same period. Its return on invested capital has averaged 10.9% from 14.3% in 2012 to 14.8% in 2021, despite several headwinds in the past. No wonder why Coca-Cola has been one of Warren Buffett's favorites for decades now. At its present share price of $60 and conservative earnings per share predictions of 6% annually, our model projects that Coca-Cola's stock will have annual returns of 7.8% over the next 5 years. And last but not the least, we have Intel Corp. The Intel Corporation develops, produces, and markets computer hardware and related goods. Microprocessors, chipsets, embedded processors, microcontrollers, flash memory, graphic, network and communication, systems management software, conferencing, and digital imaging technologies are some of the company's main offerings. Prior to the COVID crash of 2020, Intel's stock price has been trading around $68 a share. Due to the market fears at the time, the stock sharply dropped 35% from its peak to around $45 a share. Although the stock managed to recover to pre-pandemic highs, its current price is still trading at a bargain at around $27 a share due to the current macroeconomic climate. Intel recently announced it was still on track to regain chip production leadership. It has been hitting all the targets it has set on a path to regain this dominance in the semiconductor manufacturing, according to the executive responsible for the effort. We're completely on track. Intel Vice President Ann Kelleher, the head of technology development, said Monday in a press briefing in San Francisco. We do quarterly milestones, and according to those milestones, we're ahead or on track. Pat Gelsinger, the chief executive officer of Intel, has vowed to restore the company's decades-long dominance in the $580 billion market by regaining leadership in production technology, in an effort to make up for the chipmaker's 5-year delay in delivering a manufacturing technology. Kelleher's team is working to develop a new method. The team is moving forward with the introduction of new processes at an unprecedented rate. If Gelsinger's strategy is successful, Intel may be able to regain market share that it has lost to competitors like Advanced Micro Devices Inc. and NVIDIA Corp. The CEO's endeavor to compete with Samsung Electronics Co. and Taiwan Semiconductor Manufacturing Co. in the expanding contract manufacturing sector, which produces semiconductors for other chip firms, will also be made possible by improved production at Intel. Looking into Intel's historical revenue, it booked $53 billion in 2012, which grew to $79 billion in 2021. That's a 49% increase in revenue in just a decade. It averaged $64 billion over the same period. Intel has maintained a fat operating margin of 28.2% on average over the past 10 years, from 27.4% in 2012 to 27.9% in 2021. Based on our conservative estimates, Intel is estimated to make an average return of 5.7% annually over the next 5 years, when you include the dividend returns as well as the growth in share price. If you're looking for some blue chip stock with high dividend yields, Intel surely is one top pick. And last but not the least, we have Walgreens Boots Alliance Inc. Walgreens Boots Alliance is the largest retail pharmacy in both the United States and Europe. Through its flagship Walgreens business and other business ventures, the $28 billion market cap company has a presence in more than 9 countries, employs more than 315,000 people, and has more than 13,000 stores in the US, Europe, and Latin America. The company engages in the provision of healthcare and retail pharmacy services. It operates through the following segments: United States Retail Pharmacy, International, and United States Healthcare. The U.S. Retail Pharmacy segment includes the operation of retail drugstores, health and wellness services, specialty and home delivery pharmacy services, and equity method investment. Pharmacies-led health and beauty retail companies outside of the U.S. are available through the International segment, as is the pharmaceutical wholesaling and distribution company in Germany. Through owned and partnered assets, the U.S. healthcare segment improves health outcomes while lowering costs for payers and providers. Prior to the 2020 market crash, Walgreens' stock price was trading around $53 a share. Although markets globally were crashing for more than 40% during that month, Walgreens' stock only tanked 25%, the most, to around $40 a share. Although its stock managed to recover to pre-pandemic highs when it peaked to around $56 in April of 2021, its price now is again trading at a discount in the middle of the current global market downturn. Walgreens Boots Alliance Inc. is reportedly the first major national pharmacy chain to say it plans to dispense the abortion pill under the FDA's new rules. The FDA recently announced it would allow pharmacies to offer abortion pills, mifepristone, in the U.S. Pharmacies must complete a form for certification to distribute the abortion pills. Any pharmacy to become certified to dispense mifepristone, an FDA-approved medication for use up to 10 weeks in pregnancy. Other companies that may follow suit include CVS Health Corp. And Rite Aid Corp., according to the Wall Street Journal. This clearly shows Walgreens' dominance in its own sector. Now let's look into hard numbers. Walgreens has booked a $72 billion revenue in 2013 and $133 billion in 2022, a whopping 85% revenue growth in just 10 years. This averaged to around $116 billion over the same period. Its operating margin has averaged 3.6% from 5% in 2013 to 0.7% in 2022. Though its operating margin has tightened, we still see progress in its return on invested capital, from 10.6% in 2013 to 11.5% in 2022, which averaged 9% over the past 10 years. At its present share price of $34 and conservative earnings per share predictions of 4% annually, our model projects that Walgreens stock will have annual returns of 14.3% over the next 5 years. There you have it, folks. Those are our top 5 dividend stock picks for this week. Comment down below your favorite stock pick, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing day ahead.